The broadcast is now starting. All attendees are in listen-only mode.
Very good afternoon to all the participants of this webinar. Just give us a couple of more minutes so that the other attendees can join. We will be starting in exactly 2 minutes. So kindly hold on.
$700 is fine. So, I'll be just, in case if I have an issue, I'll come. Otherwise, you'll be very close.
Okay, sorry for the slight delay in starting. So a very warm welcome to all the participants of this webinar on tax planning. I am Samira, co-founder of Paybooks, and I will be taking this session. The start of the story is always good, right? A person has a good job, a great salary, and he has big dreams. Buying a house, I want a nice car, or I want to go on a foreign tour, or save for my children's education or marriage, and so on. But then you are reminded of the famous quote by Benjamin Franklin: "Nothing is certain in this world except death and taxes." Yeah, income tax. The words we hate so much. So much of confusion and so many questions all of us have on how to save tax, where to invest, how much to invest, under what conditions, what are the rules I should be aware of, should I claim HRA or going for a home loan, or should I claim both HRA and the home loan? Okay, so don't be disheartened. None other than the great Albert Einstein has remarked, the hardest thing to understand in this world is income tax. And he was not even referring to the complex Indian Income Tax Act. So today let's make a small start to understand something more on income tax and the various avenues to save tax. Another famous saying goes like this: there is never a convenient time for death, childbirth and taxes. But with the financial year end approaching, all of us are busy in submitting our proofs and claims to the employers. So it is all the more important that you make a last ditch effort to save some tax. So before we start, so this webinar I should be completing in an hour's time. We can reserve the last 10 minutes for a Q&A session, and I hope I will be able to answer all your questions. We will be putting up the recorded webinar on our website, which is www.paybooks.in. Please give us around 5 business days, and then you can use the recorded version of this webinar. So what will be the key takeaways from this webinar? At the end of this webinar, you can look forward to have some better idea on what are the tax rates, what is your effective tax rate, and how tax saving is different from tax shaving, or in other words, tax avoidance and tax evasion. What is tax planning and how is it part of the overall financial planning? And for people who thought tax planning was the most difficult to do, you haven't heard of the financial planning. We will also be covering what are the taxable heads as per the Income Tax Act, and we will finally move on to the crux of this webinar on the deductions. So what are the various deductions which are allowed as per the Act? What are the do's and don'ts, and how to maximize the savings with some tips. So the first point you should be aware of while doing your tax planning is to know the tax rates applicable for the financial year. So for 2013-14 financial year or the assessment year 2014-15, you have a basic exemption of rupees 2 lakhs. And for people aged between 60 and 80, instead of 2 lakhs, it is 2.5 lakhs. And for people who manage to live beyond 80 years and yet manage to have some income, they need not pay any taxes till 5 lakhs. So we will show you this specifically later as to how you can benefit from this 60 plus and 80 plus years later in the presentation. All the incomes between 2 and 5 lakhs are taxed at 20%, and any income which is beyond 10 lakhs, it is taxed at 30%. A surcharge of 10% is applicable if your income exceeds 1 crore, and also a 3% cess is payable. So just to clear the confusion for some people on how to calculate the tax, a simple working is given here. Assume that the taxable income is 12 lakhs. So on the first 2 lakhs, you have a basic exemption, so there is no tax. On the 3 lakhs, which is between 2 and 5 lakhs, which is taxed at 10%, so you have 30,000 there. And the next 5 lakhs, which is the income falling between 5 and 10 lakhs, it is taxed at 20%, so you have 1 lakh here. And you have 2 lakhs out of the 12 lakhs of income, which is falling in the 10 to 12 lakhs slab, so which is taxed at 30%. So the total basic tax in this case is rupees 1,90,000. If you add the education cess of 3%, the total tax is 1,95,700. So in this case, the effective tax rate is the total tax, which is 1,95,700, divided by the total income, which is 12 lakhs, which is 16.31%. So though the highest slab of 30% is applicable for this person, his effective tax rate, given that there is a basic exemption and different tax rates for 2 to 5 and 5 to 10 lakhs, the effective tax rate works out to 16.31%. So knowing the effective tax rate is the second step in your tax planning. So all the efforts of tax planning go to see that this effective tax rate is as low as possible, and so you should be very well aware of this effective tax rate. So moving on, it is very important to know what is the difference between the tax planning, avoidance and evasion. So we often tend to mix all these terms together, and actually they are quite different from each other, And so though tax avoidance and planning sometimes they have a very thin line of difference, tax evasion is altogether a very different concept. So what is tax planning? When you use various provisions in the Income Tax Act to save your taxes, it is called tax planning. So for example, there is a section called section 10 subsection 13A, which deals with your HRA claim. So using this 1013A and claiming a deduction towards the rent paid is tax planning, because you are using a provision which the government intended you to use. But the same thing if you want to compare with tax avoidance, it happens when you use a loophole in the Income Tax Act to save taxes. So for example, there is a new requirement on HRA that you submit the PAN of your landlord if your rent exceeds a certain amount. So if you declare a dummy PAN as the PAN of your landlord, you are using a loophole because the Act does not specify certain things and you can easily get away with quoting the wrong PAN. So this is avoidance. And showing rupees 25,000 as rent paid when you are actually paying only 10,000 of rent is tax evasion. So obviously in this session we will be discussing only on tax planning methods. Please avoid all tax evasion completely so that you have a peaceful night's sleep. So what is the relationship between tax planning and financial planning? Tax planning is only a very small part in the bigger financial plan. So tax planning is always done keeping the end financial goals in the horizon. So all the people need to plan their cash flows, cost of education of their children or their own education. They need to do some portfolio planning in terms of what to invest, where to invest, how much to invest, how to manage the lifestyle after retirement. There should be a component of real estate planning and how much to get insured for covering your life and health, how much to plan for or how to plan for your succession and inheritance tax. So if you observe, all these activities which form part of the financial planning, from cash flow to inheritance, all of them involve big touch points with income tax. So the better you plan your taxes, the better financial planning you do. So this is a very key aspect to a good tax plan. So you should always keep in mind the bigger financial goals while taking decisions on your tax planning. So don't buy, for example, an insurance policy just because your mother told to help some poor insurance agent, or because you saw an ad which advertises for a single premium and you think it is easier to manage. So in other words, don't allow the tax tail to wag the bigger financial dog. Always the dog wags the tail. So this is very key, and I have tried to keep this in mind in this presentation. So what are the taxable earning heads as per the Income Tax Act? You should be aware. So at a high level, there are 5 categories which the Income Tax Act recognizes. This is income from salaries, income from house property, income from business or profession, capital gains income, and other sources. So in this session, I will be mostly dealing with income from salaries and house property. I will not be touching upon anything concerning the business or capital gains, and even from other sources, I will be dealing only with your bank interest under deduction available under under chapter 6A. So let's start with the deductions from your salary income. So at the outset, a bad news for all. Tax planning revenues for salary income is very, very limited. The main reason for this is that the employer first needs to pay a particular component as part of your salary package so that you are eligible for the deduction. So for example, you can take children education allowance. So not many companies have this as part of their compensation structure. The main reason could be that this exemption is granted for a meager rupees 100 per child up to maximum of 2 children. So the max deduction one can get is rupees 2,400 per annum. So there are many such outdated provisions in the Act, and maybe for a right reason many companies don't have these small salary heads. So even say you have 2 children and they go to school, you can't claim this allowance if it is not part of your salary income in the first place. So hence I will not be talking about many such other items like hostel allowance, hilly area allowance, border allowance, etc. I will very briefly talk about the more commonly used salary components like HRA, LTA, and medical allowance. And let's see if there is any interesting Gyan knowledge we can make use of. So the biggest deduction for a salaried employee is usually the HRA. So I will try to spend more time on this and try to clear some misconcepts on HRA. Also, HRA plus home loans is a very, very good combination, and both from the confusion perspective and overall financial planning perspective, I am going to deal at length on this combination of HRA and home loans. So for the record, this is how deduction for HRA is calculated. All of you will be well aware of this. So least of the following 3 is exempt from your taxable income. Rent paid over and above 10% of your basic plus DA if you have it. 40% of basic plus DA if you live in a non-metro, or 50% if you live in a metro city. And the last one is the actual HRA received as part of your salary. So the least of these 3 is exempt. So to claim deduction under HRA, you need to fulfill these conditions. So first of all, you need to stay in a rented house, you need to pay rent, and you need to submit the original rent receipts to your employer. Now there is a new requirement which mandates that if your rent exceeds rupees 1 lakh per annum, or converted to a monthly sum, it is rupees 8,333, then you need to declare the PAN of your landlord. And there is also a small consolation for those paying rent below rupees 3,000. So for these people, the requirement of submitting the rent receipts is done away with. So the first point you need to note on HRA, if your company has a FBP policy and if HRA is part of this basket, then you should always choose 50% of basic if you stay in a metro city and 40% if you are in a non-metro city. And again, just to clear the misconception here, metro cities are not those cities where there is a metro train facility, but it is the notified cities of Kolkata, Chennai, Delhi and Mumbai. So now there is a huge savings possible if you pay rent to your parents. So in the next couple of slides, I will have more details on this with a detailed working. But you should also remember that while you can pay rent to your parents, you cannot pay rent to your spouse, say to your wife, even if she is a homemaker. A very important point to be noted for all those people paying rent below rupees 3,000, the exemption is only in submission of the original rent receipts to your employer. But still, all of you need to maintain the receipts and produce them if demanded by the tax department if you get assessed. So for others too, it is highly recommended. It is highly recommended that you open a small file and keep the photocopies of the rent receipts you submit to your employer for future use if required, along with the original rent agreement. Even that is very important, because in a case you get an assessment notice and you are called upon to submit all the proof of your savings and bank transactions, etc., there is a very high chance that you will be asked to submit the rental agreement in the first place, based on which your employer has given you the HRA deduction. I also have a small illustration to show how you should be distributing the rent claim if both husband and wife are working. So this is an illustration to show, in a case where you can pay rent to your parents, how you can save tax big time. So assuming that your taxable income without the HRA claim is rupees 13.5 lakhs, and say you have parents aged 60 and above, and suppose you show a 30,000 rent paid to your parents. So straight away 3.6 lakhs is reduced from your income, but at the same time the same 3.6 lakhs is added as income to your parents. On the rental income, there is a standard exemption which the Act provides. So there is a 1,08,000 deduction. I'm sorry, I think there is a zero missing in 1,08,000. And then, so the taxable income for you will now be 9,90,000, whereas for your parents it will be 3,60,000 minus 1,08,000, which is 2,52,000. So tax on 9,90,000 works out to 1.31 lakhs, and since the exemption limit for 60 and above aged people is 2.5 lakhs, on the 2,000 rupees, a 10% tax, that is rupees 200, is the tax payable by your parent. So if you see the original tax on the 13.5 lakh of income, it is 2.42 lakhs. So you have a saving of 1,10,000 from your income tax if you have the provision of paying rent to your parent. Moving on to the illustration on who should claim the HRA if both husband and wife are working. So here I have assumed the rent to be at 20,000 rupees per month, and suppose your income is 12 lakhs and your spouse is earning 8 lakhs, assuming this is before the HRA claim. So if you claim the HRA benefit in full, you will claim this 2.4 lakhs, which in case your tax is 1,25,000 and your spouse pays say 92,000. So the total tax both of you pay together is 2.18 lakhs. So in option B, if both husband and wife claim this 2.4 lakhs of rent equally, then the total tax paid by both put together is 2.26 lakhs. But if only your spouse claims the full 2.4 lakh deduction towards HRA, the tax on the income is 2.38 lakhs. So if you compare option A and C, you can see the vast difference. So before you decide on who has to claim how much, I think a small working like this has to be done. So if you observe here, all things remaining same, the difference between the best and the worst options equals 1 month of rent. Now let us come back to this requirement of submitting the PAN of the landlord to your employer. So now it is very obvious that if you are searching for a new accommodation, rented accommodation, you not only need to find a good house with affordable rent, but also an owner who has a PAN and moreover willing to share his PAN. So all the very best to all of the people in this position. So let's see the options if your owner doesn't have a PAN. So you need to just get his signature on a simple document stating that I, Mr. So-and-so, residing in this address, have given on rent to Mr. So-and-so the house with address so-and-so, and I do not have a PAN, and he needs to sign this. So this declaration you will be required to submit to your employer, and so any rent you actually pay and claim will be allowed if it is accompanied by this declaration. So now the tricky part. What if your owner refuses to share his PAN and he also refuses to sign this declaration? So let's see in this scenario what is the rent you are paying. If it is say very close to rupees 8,333, which is the threshold, say it is rupees 10,000 per month. So in a case where your owner is refusing to share his PAN and also to sign the letter, the best option would be to declare a rent of 8,332, which is just below the threshold limit, and thus you will be completely out of the PAN requirement. So instead of using the full HRA benefit by declaring 10,000 as rent and not being able to substantiate that with the PAN or the letter, it is better that you forego a small 1,600, 700 rupee from the rent and get the full benefit of this 8,332 as your rent per month. Now suppose you are paying a bigger rent, say 25,000 per month, and you are in a scenario where your landlord is not sharing his PAN nor signing the letter. So what should you do? So don't lose heart. So though this is not a guaranteed solution, but this is definitely worth a try, and 90% of the time you will be able to claim the benefit. So what you should do? So first is don't declare any rent with your employer. So if you don't do this, then the employer will deduct the applicable TDS without the HRA benefit. But when you are filing your IT return, you need to recompute your income by taking the HRA deduction. And today itself, you will need to send a formal letter to your landlord through registered post acknowledgement due, asking him to share his PAN because of the requirement specified by the Income Tax Act. So preserve this letter safely, and in all probability your landlord will not reply. So this registered post acknowledgement due, whatever you get from the postal department, you please file this safely in a file, and when you get a section 143 notice from the department because your income and the form 16 income will not tally and you would have claimed a refund, then you please submit this letter which you have filed, which you have sent to your landlord. And in my opinion, this letter or this claim will be a proof in lieu of the declaration of no PAN, and the assessing officer in this case will allow the HRA deduction. I will slightly go off record because this is what is happening practically now. So though the requirement of the circular of declaring the PAN of landlord is there, unfortunately or fortunately there is no format which the circular has mandated. So it just tells PAN of the landlord, or in the absence a declaration has to be filed. So this can be in a simple white paper, and there is no other signature which is specified. So just a plain paper with the landlord's PAN is sufficient to comply with the circular. So now what would prevent a person from writing a fictitious PAN there? So no check is mandated on the employer to verify that whatever PAN the employee has written or submitted is of his landlord only. So there is a loophole, at least currently in the Act, where the requirement is just to submit a PAN of the supposedly the landlord, but there is no preventing somebody from declaring a false PAN. So based on this, don't give the PAN of your company's director or HRA, then land him in trouble with the department. So, but actually this loophole is there from a long time, though for a different section, and the government should have taken note of this while rolling out the circular. So what used to happen was, while registering any property above a certain notified limit, you need to declare the PAN of both the seller and the buyer. And there are multiple instances of people quoting some 10-digit number as the PAN, and the registrars don't check anything at all, and people end up quoting the PAN of people they don't like, register the property, and that poor person will get a notice from the department after 3-4 years, and he has to run from pillar to post to get this solved because he has actually not purchased or sold the house. So an important point to be noted when it comes to claiming both HRA and home loan deductions. So this table should clear all the doubts. It is definitely legal to claim both the HRA and the home loan deduction, as long as you satisfy the conditions laid down in these two sections. So if you live in a house on which you have a loan, then you can claim interest deduction of up to 1.5 lakhs and the principal of rupees 1 lakh. But since you are in your own house, there is no HRA deduction. If you live in, say, city A in a rented house and own a house in a different city on which you have taken a home loan, then you can claim both HRA and the interest principal deductions. Say you live in city A in a rented house and you own a under construction house in the same city on which you have a home loan. So in this case, you can claim both HRA and the principal interest deductions. But since it is an under construction house, there are certain conditions that you need to claim interest only after the construction is complete in 5 equal installments. Suppose you live in a city in a rented house, and in the same city you own a house on which there is a home loan, and you have rented that house out, then you can claim the HRA and the actual interest you pay. So in this case, there is no 1.5 lakh limit. Since you have rented out the house, you can claim the actual interest and up to 1 lakh as principal. However, you need to keep in mind that you need to offer the rent whatever you receive to tax. So let us come back to HRA and home loans a little later. Let's quickly glance through the LTA provisions. Most of us know what is LTA and have been claiming this, but specifically I wish to draw your attention from a tax planning perspective to points 3 and 4 in this slide. Ensure that you don't lose out on the claim in this block if you couldn't avail the LTA claim in the last block for whatever reason. And there is one more loophole which has got opened up with the online ticketing system, is that both the husband and wife can now claim the LTA benefit for the same tickets as they satisfy all the conditions given in the Act. What are the conditions? You must have travelled, you must produce original supporting tickets subject to certain conditions. So in the age of electronic ticket booking, there is no limit on the so-called original tickets, and both the husband and wife can take these tickets and enjoy the LTA deduction or a double deduction for the same travel. When it comes to the medical reimbursement, you should be aware that you can submit any bills, including bills for any medical treatment of any sort. So a common myth is that only bills at the medical shop is available for deduction, which is wrong. And one more tip which I could give here. So this medical reimbursement, which has a 15,000 cap on the deduction, is actually a seemingly harmless looking deduction, but most of us tend to lose out when you check the adequacy of the bills you have in the month of Feb or March, depending on when you need to submit your proof to the employer. So just to make sure you have all the bills, it is suggested that you go the good old days, open a hard file, and yes, it can be the same file where you have filed the rent agreement and the receipts. Keep saving all the bills, and believe in the saying that little drops of water make a big ocean. So small bills bunched together will definitely take you 15,000 and above. So while we are on the topic of medicines and medical treatment, let's finish the deduction available on the medical insurance too. So to keep this webinar very non-technical, I am ignoring mentioning the sections as much as possible. So for the record, the medical reimbursement and medical insurance deductions are under very different chapters and sections in the Act. So the deduction you get on medical insurance payment is given here. So based on the age of yourself and your parents, the deduction is either 30,000 if none of you and your parents are 60 and above. If only your parents are 60 and above, the deduction is 15,000 plus 20,000, which is 35. And if all are 60 and above, you can claim a maximum of rupees 40,000. A new section which was introduced here is the preventive medical check expenses. Of course, this is covered within the 15,000 limit explained in point 2, but the government is now recognizing the need for having the preventive medical checks also as part of this section 80D. So coming back to homes and home loans, I am concentrating more on the HRA and the home loans. As already mentioned, home loan deductions are the biggest deductions a salaried person can get. So whether it is principal repayment or payment of stamp duty and the registration fee, you can claim a deduction of up to rupees 1 lakh. Of course, this 1 lakh limit is including the other things like PF, life insurance premium, ELSS, pension scheme, etc. But nevertheless, you should be aware that you can claim up to 1 lakh deduction towards the principal payment on the home loan. Coming to the interest part, while most of us know that the limit is rupees 1.5 lakhs in case you stay in the house on which you have taken the loan, and if it is let out, the full and actual interest can be claimed as a deduction. Most of us will not be aware that there is a condition which stipulates that if the construction of the house on which loan is taken is not completed within 3 years, then the limit is just rupees 30,000 and not 1.5 lakhs. So while the employer may not know this and gave the full 1.5 lakh deduction based on your false claim, if you get an assessment notice, you will have a bad time. So not only will you need to pay the tax on the difference between 1.5 and 30,000 for the number of years you have claimed a false deduction, the officer also will in most cases levy an interest and a 300% penalty for suppressing or supplying false information. So you should be aware of the condition of construction to be completed within 3 years. A new section now provides for additional deduction of rupees 1 lakh on the interest payment if you satisfy these conditions. So the loan should be sanctioned between the financial year 13-14. Loan should not be more than 25 lakhs and the value of the house should not be more than 40 lakhs. The last condition is that you do not own any other house in your name. So just to break the monotony on this, so the way a normal person like you and me read these lines is very, very different from how a seasoned CA reads the same thing. So for example, if you show these 4 conditions to a CA, he will read it like this. So on the first point, he will tell, oh, okay, so it is just that the loan sanction date is mentioned in the Act. So even if a loan is disbursed after 31st of March 2014, I am eligible for a deduction. And on point 2, he will immediately tell, he will not read that the loan value should be not exceeding 25 lakhs and keep quiet. So he will go beyond. So this is called as reading between the lines. So he will tell if anybody has to claim a deduction under this section, his salary should not be less than 45,000 rupees per month, because only then a person will be eligible for a loan of 25 lakhs. So banks usually adopt a 5 times rule to fix the loan eligibility. So a minimum of 5 lakhs per annum salary is a must if you want a loan for 25 lakhs. So on the third point, a CA would tell, okay, so the value of the house is 40. He will go back to point 2 and tell loan is only 25 lakhs. So that means I should make a down payment of rupees 15 lakhs and also bear the cost of registration and the stamp duty. On the fourth point, he will immediately tell, okay, so I should not be owning any house in my name to claim deduction under this section. So let me transfer the current house to my spouse or gift it to my son or daughter and thus become a person not owning any house. So this is how reading between the lines is done by a seasoned expert. Okay, and very, very important, most of us will not be aware of these provisions. You should definitely be aware of this and not repent later. Just don't go by some advertisement or an online article you search before making an investment. You should collect all the information and sometimes even consult an expert, and consultation need not always result in paying the expert. There are various ways and means you can reach out to an expert. So the house on which you have claimed the principal deduction under section 80C, you cannot sell it within 5 years from when you obtain the possession of the house. If you do so, then whatever deduction you have claimed for the 5 years under section 80C, let us assume it is the full 1 lakh, then the complete 5 lakhs will be added back to your income in which year you have sold the house, and it will be taxed accordingly. You should also be aware that there is a small change which the deductions undergo if this is a case of a under construction house. So the interest payment made in this period, that is till the construction is complete, has to be claimed only after the completion of the construction, and that too not in one shot but spread over 5 equal installments. So again, you should ensure that the construction is completed within 3 years, and also remember to keep the necessary papers to prove that the construction is complete. You should also be aware that while an under construction property is generally available at a lower price than a constructed property, you should be aware that you are paying an element of service tax in all cases of under construction property. But if you purchase a fully constructed house, then you need not pay any service tax. The principal part, even for an under construction house, is completely allowed under section 80C up to rupees 1 lakh. Now coming to the deduction basis, again something most of us will not know. You can claim the interest deduction on due or payable basis. That means if your loan schedule mandates you to pay say rupees 1.5 lakh as interest for this year, and for some reason you haven't been able to pay and you pay everything say in the next year, you can still claim the rupees 1.5 lakh deduction in this year itself, because interest can be claimed on due basis. So interest is due to be paid to the bank this year, hence you can claim the amount though you haven't actually made the payment from your bank. On the principal, it is on actual payment basis. That means again reading within the lines, even if you pay 1 lakh as principal this year, but it actually pertains to the last year, you can still claim the deduction. And as a last or a general advice on homes and home loans, it is advised to buy the property in the joint name of husband and wife, so that the deductions can be maximized, as both the husband and wife can claim the full deduction of rupees 1.5 lakh or the actual interest, as the case may be. Since I think we are running out of time, I will quickly take you through the other deductions which are available. I will not be spending too much of time on these, as most of us are aware of these deductions, and also because the deduction is limited to only rupees 1 lakh for most of the items. And more importantly, the decision to invest in many of these items which are listed in this section is not to be taken only with keeping the tax benefit in mind, but the overall financial plan. So buying an insurance policy just to save tax is not at all recommended. So chapter 6A has various deductions, and I have tried to categorize them in a different way so that I don't confuse you with sections and subsections. So some are investment based, some are expenditure based, some are loans, earnings, and if you spend on any medical treatment and insurance, there is a deduction. Even if you donate, there is a deduction. So let us very quickly go through them. The political parties, 60,000, trust which are approved up to 40,000, you can claim a benefit. And if you are confident that our Babus, Narendra Modi or Kejriwal or Rahul Gandhi, whoever is the lucky or unlucky guy, will actually utilize the 1 lakh donation in ensuring rural development, please go ahead and donate rupees 1 lakh and do your bit for the nation. So loans, home loans, we have already discussed at length. Even on educational loans, you can claim a deduction. The condition is the education loan should be taken either for yourself, your spouse or children. The purpose should be for higher education, that is education after the 12th or senior secondary exam. And as per the recent amendment, even vocational courses are eligible for this purpose. And also the course can either be in India or outside India too. Loans cannot be taken from say relatives and like deduction claim. Only approved financial institutions like banks are, I mean, if you take a loan from these, you can claim the deduction in this section. Deduction is only on the interest portion and not on the principal portion. And you can claim this deduction for a maximum period of 8 years. So remember one thing here, that the loan should be in your name. So suppose your father has taken the loan for your studies and you are repaying that loan, still you cannot claim the deduction, but only your father can. So medical spend, so I have already talked upon the insurance for the medical purposes on self and parents. The planning here is very, very limited, and CAs generally overlook this, as you cannot really plan anything here on getting sick or getting the specified diseases here just to claim the deduction. So investments, basically there are two types of investments on which you get a deduction. One is equity investment and the other is a debt investment. So in equity you have the ELSS and the new Rajiv Gandhi Equity Savings Scheme. So since this Rajiv Gandhi scheme is a new one, I will take a minute of the time to explain. So if you are earning less than rupees 10 lakhs and you are a first time equity investor, you are eligible to claim the deduction. So if you invest rupees 50,000, which is the maximum limit in the approved stocks and funds, mutual funds, then you get a maximum benefit of rupees 25,000. So while opening a demat account in this scheme, you should remember to submit a form called Form A, which the broker will have, so that this is designated as a Rajiv Gandhi scheme transaction. There would be a lock-in period of 1 year for the investments made, and from the second year onwards you can sell the units, but at no point of time should your balance in the demat account be lower than the deduction you have claimed. Otherwise all the deduction you have claimed earlier will be reversed. So this deduction under the Rajiv Gandhi scheme is available only for 1 year, but with the same demat account you can continue to trade in non-Rajiv Gandhi scheme shares, and also those will not be subject to the lock-in period restrictions. So the other main investment is the life insurance, and again a very quick highlight on the life insurance premium, more from a financial planning aspect. So you have many types of insurance. You have term insurance, whole life, money back, endowment insurance, and unit linked or market linked plans. So what is a term insurance? Where the cover is available only for a specified term or a period. So benefit is given only if the policy holder passes passes away during the term of the cover. So what is whole life? Whole life covers the holder for as long as he lives. And in case of a money back policy, not only the life is covered, but also it assures a certain return. It is more a savings plan with added insurance benefits. An endowment plan will give you at maturity a lump sum which is equal to the sum assured plus the dividends. And in case of a unit linked plan, the premium you pay is invested in various funds, mutual funds and equities, basically a basket of securities, and the insurance company hopes to give you a good return apart from the insurance cover. So you should be very well aware of which policy to choose from. A very small example to highlight the need of knowing more. Assuming that you are 30 years of age and you have taken a policy with a 10 lakh cover for 30 years. So the premium you pay in an endowment plan is around rupees 26,500, whereas for the same cover for the same period, if it is a term insurance, unlike 26,500 premium, you need to just pay rupees 3,500. So there is a lot of difference between the plans. So don't get fooled by a smooth talking insurance agent, or think some agent is very needy and then you need to help him by buying a plan. So always buy insurance after proper analysis. Always keep in mind that you should separate your investment, tax and insurance decisions so that you optimize your returns. So then you have your PF, PPF also here. So again, from a financial planning angle, it is worthwhile to open a PPF account, since it gives a tax-free interest rate currently, which is around 8.7%. So remember, this is a tax-free rate. So assuming if you are in the 30% tax bracket, if you gross this up, this translates to a return of 12.4%. So not only the high returns, but this is also very safe since it is backed by the central government. Now you can even deposit the money in the PPF account online with your net banking, and it would act as a compulsory savings without you knowing. At the end of the 15th or 20th year, you will have a good corpus. So even if you start investing rupees 10,000 each year, at the end of the 15th year, you will have close to 2.95 lakhs because of the good interest, and also chiefly because of the compounding effect in the PPF account. On the expenditure side, you get a deduction for the tuition fee you pay for your children. On the income side, if you have any interest from your savings account, not the fixed deposit but only the savings account, up to rupees 10,000 it is exempt. So I think we have reached the end of our allotted time slot. So hopefully from a state of confusion to some level of confidence, we have taken a very small step. So you should always be aware that there are various tax provisions, some which you know, some which you don't know, and some which you cannot comprehend also. And keeping all this in mind, make tax planning only a part of your overall financial planning, and you will then be very sure to taste a better success. So I have reached the end of my presentation. Let's see if there are any questions which I can answer in just 2 minutes. So if you have any questions, you are free to type it on your panel on the right hand. I will quickly check if anything can be answered. No, so I don't have any questions asked by the participants. So thank you all of you for a very patient hearing. Please fill the poll once you log off and help us plan and provide you better topics. Please feel free to see the recorded version of this webinar in 5 days time. Hopefully by then we will have the recorded version available online, and you can drop me an email for any questions you might have.
Please ask question.
Okay, thanks a lot. Bye.
Recording.